In life, cause and effect govern everything we do. It's a simple but powerful truth. When one action is taken, another follows. If someone punishes you, the natural instinct is to want to retaliate, especially if you have the power to do so. This is true not just for individuals, but also for entire nations. Today we are witnessing how this age-old principle of retaliation is playing out on the global stage, especially in the context of the U.S. China trade war. For decades, the United States enjoyed unparalleled economic dominance. It could impose tariffs, taxes, and sanctions with little fear of serious repercussions, confident that its massive economic power would back up its actions. When the U.S. imposed a penalty, the rest of the world had little choice but to comply. This was especially true for countries that were economically dependent on U.S. trade. The U.S. had the upper hand, and for the most part, it wielded this power with confidence. But today, that narrative is rapidly changing. What we once thought was an unshakable position is now being questioned by the rise of China, a nation that has fundamentally changed the dynamics of global trade. A perfect illustration of this is the U.S. China trade war, sparked by the Trump administration's decision to impose tariffs on Chinese goods. The 10% tariff was intended to boost American manufacturing, punish China for its alleged unfair trade practices, and bring jobs back to the U.S. But instead of strengthening the American economy, the tariff has had the opposite effect. It's backfiring. China, the once subordinate economy, is now a powerful force to be reckoned with on the global stage, and the U.S. is beginning to feel the consequences. China's economic transformation is nothing short of remarkable. In the 1990s, China was a low-cost manufacturing hub, largely reliant on foreign investment and technology. But now, China is the world's largest manufacturing and industrial economy, having surpassed the U.S. in many critical sectors. In fact, China isn't just catching up. It's overtaking the U.S. in key industries, from technology to renewable energy to automobiles. What was once a world order dominated by the U.S. is now being redefined by China's economic and technological might. The scale of this shift is profound, and it's happening right before our eyes. So, how has China responded to the U.S. tariffs? It's simple, with retaliation. The Chinese government has imposed a 10% tax on American-made cars, a move that directly targets major U.S. automakers like Tesla, Ford, GM, and Mercedes-Benz. Now the cost to export a heavy-engine vehicle from the U.S. to China is 25%, thanks to the combined effect of the U.S. tariffs and China's retaliatory measures. This is no small matter for American automakers, which have long relied on China's booming car market as a key revenue source. The 25% tax is essentially a death sentence for U.S. car exports to China, and it's an effect that has far-reaching consequences for the American auto industry. However, before we jump to conclusions and declare this the end of the road for U.S. automakers, let's take a deeper look at what this really means. That additional 10% tax is essentially a near-total ban on American-made cars in China. The cost of manufacturing vehicles in the U.S. is already much higher than in China. U.S. factories face outdated technology, higher labor costs, and expensive energy costs compared to China's modern, automated manufacturing plants. To make matters worse, China isn't just focused on traditional internal combustion engine cars anymore. It's also leading the charge in the electric vehicle, EV industry. Companies like BYD are pushing the boundaries of innovation with highly automated factories that use advanced robotics to build cars faster, cheaper, and more efficiently than any U.S. automaker can manage. These factories are so advanced that they produce world-class vehicles at a fraction of the cost of American counterparts. The result? Chinese cars are now not only competitive, they're setting the standard for affordability, innovation, and quality. What this all means is that Trump's so-called four-dimensional chess approach to trade has been nothing but a colossal mistake. In his bid to protect American jobs and industries, he has inadvertently set the stage for a massive loss of American market share in one of the most important global industries. U.S. automakers are finding themselves in an increasingly tough position. If exports to China continue to decline, and if Chinese automakers continue to innovate and lower their costs, U.S. companies will find it harder and harder to compete. This isn't just about trade. This is a classic example of cause and effect in action. Consider the numbers for a moment. In 2024, U.S. automakers like Ford and GM exported over $3 billion in vehicles to China. But now, with China slamming the door on American-made cars, those exports will likely plummet. The Chinese market is the largest car market in the world, with domestic sales surpassing 22 million vehicles in just 1 year. No other country comes close to matching that level of demand, and the competition in China is fierce. Chinese consumers have a wide variety of options, from global brands like Volkswagen and BMW to local Chinese brands like BYD and NIO. If U.S. automakers can't compete, they'll simply lose market share to the brands already established in China. Ford, for example, could see its earnings drop by $2 billion in 2025. That's a huge blow for a company that was already struggling. But the damage doesn't stop there. Ford is also grappling with quality control issues, which, when combined with China's new tariffs, will only exacerbate their financial troubles. Even if Ford continues to export to China, it will likely lose money on every car it sends to the region, further eroding its bottom line. The consequences of this are far-reaching, not just for the auto industry, but for the entire U.S. economy. While Beijing's tariffs may not cause significant harm to China's economy, they have the potential to cripple U.S. manufacturing. China has spent the last decade quietly building an industrial juggernaut that now dwarfs the U.S. in terms of production capacity. Chinese manufacturers can produce goods at a fraction of the cost of U.S. companies, and with tariffs providing them an added layer of protection from the U.S., China has effectively insulated itself from American trade policies. Today, Chinese automakers account for 32% of global vehicle manufacturing, a staggering figure that far surpasses the U.S.'s 11% share. This gap is only growing, and the U.S. is at risk of falling further behind unless it can drastically shift its approach to manufacturing. The world is changing, and U.S. automakers are going to need to find a way to adapt to survive. But so far, the signs aren't promising. This shift in the global automotive market is just one part of a broader story. The trade war is having a ripple effect across multiple industries. Trump's tariffs on steel and aluminum are another major factor. By imposing a 25% tariff on global steel, Trump inadvertently raised the cost of manufacturing in the U.S., including the cost of building cars. Cars, whether they run on gasoline or are electric, require significant amounts of steel and aluminum. As a result, prices for American-made vehicles are set to rise sharply. The steel tariffs will add an estimated $1,500 to the cost of a new car for U.S. consumers, placing an even greater burden on households already struggling with rising costs. This price increase isn't just about the raw materials, it's about the broader economic impact. As U.S. automakers raise their prices to cover these higher costs, consumers will have to pay more for cars. The question is, will they still buy them? If cars become too expensive, demand will drop, further hurting the industry. The average consumer might struggle to afford the higher prices, leading to a decline in sales that could cripple U.S. automakers even further. The problem with the tariff approach is that it ignores the broader picture. Trump has focused on extracting revenue through tariffs, but he's neglected the long-term consequences of those actions. Instead of strengthening American industries, he's weakened them by making it harder for U.S. companies to stay competitive in a rapidly changing global marketplace. The reality is that American consumers are going to be the biggest losers in this trade war. The tariffs on steel and the retaliatory measures from China are all coming out of consumers' pockets. The cost of owning a car has already risen dramatically over the past few years, with used car prices up 40%, maintenance costs up 30%, and insurance premiums up 29%. Now, with rising tariffs, cars are going to become even more expensive, and that burden will fall squarely on U.S. consumers. This trade war is far from over, and it's unclear what the long-term effects will be. Will Trump reverse his tariff policies? Will U.S. automakers adapt to the new global reality, or will they be left behind? What's certain is that China's position in the global automotive industry is only growing stronger, and unless something drastic changes, U.S. carmakers will find themselves playing catch-up in a market they once dominated. So, what do you think about China's retaliation against U.S. carmakers? Will it force Trump to reconsider his tariff policies, or is the damage already done? Let me know your thoughts in the comments below. Stay safe, hit that like button, and subscribe as we continue to track the developments in this global trade war and its impact on the U.S. economy.